Hi, my name is Rod Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it.
Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I am thrilled that you're here. And I am super excited to interview my friend today, a friend of mine that's actually in my multifamily boardroom mastermind. She's a dynamic force for good. Her name is Anna Kelly, and she has, personal real estate portfolio valued over $80 million. She's an LP limited partner in over 2,000 doors. I know you've got a GP sponsorship deal you're doing right now for $29 million on an apartment complex. And I am so glad you're here, Anna.
Thank you so much. It is my honor and my pleasure. And it's so great to be part of the boardroom. Just brings such high value to all of us. So I appreciate what you do.
Oh, absolutely. Yeah, no, we love the boardroom. And in fact, we just got 3 guys that I think that pushes the total assets being controlled by the group over 14 billion. So it's pretty freaking exciting. Got some huge hitters that just came on. But Anyway, welcome to the show. I know that you're on lots of podcasts and you speak around the country at lots of in lots of real estate investing groups and motivate women and just super excited to have you here. Now, I know your story is a little unique in that when you started and starting with nothing and all that. I'd like you to, give us a little rundown of how you got into this business, maybe where you came from, et cetera.
Sure. So stop me at any time because my story is so long, but I'll try to condense it and then let you ask some questions. But essentially, Rod, I started out in private banking. And so I learned all about retail investments. I mean, I went through financial advisory training, could tell you anything about stocks, bonds, mutual funds, was 20 years at AIG. No one ever told me about real estate. And I had a few wealthy clients that laughed when I told them the returns we could get them at our bank, which at the time in the mid to late 90s was pretty high compared to today. And I thought, wealthy people have real estate and one day I want some. So fast forward a few years, I had my first baby, Rod, and I was climbing up the corporate ladder at AIG, loved my job. But the minute I had a baby, my life changed and I wanted nothing more than to be home with my kid and have the freedom of my time to be with them. And HGTV had just started coming out with all these Flip This House shows. It was back in 2003. And I decided I need to flip houses. And if I just flip a few, I'll replace my income and it'll be easy, I thought. So I had a rental at that time. I tried flipping, lost money, didn't know what I was doing. And my husband said, we're never flipping again. That was just not fun. So, decided to be entrepreneurs. We started my husband's business, sold everything in Texas, moved to PA. And we bought a commercial building, Rod, for my husband to practice in that had 3 apartments and 4 garages with it.
Where in PA? Forgive me for interrupting. Where in PA?
Right outside of Hershey.
Okay, so in the middle of the state, kind of, right?
Middle of the state, mid-central.
Okay.
And it was this small little town where all the businesses were on Main Street. They all had, office or retail on the first level with businesses on top, apartments on top. And I was like, well, it's better than leasing space. We'd have some tenants to help pay down the mortgage. And if his business fails, we'll at least break even on the building. And that was my thought. So I became a landlord by necessity. And then also just being very careful and cautious with our money. I saw a 4-unit apartment building for sale. And I thought, well, it's not smart to build another house, starting over from nothing. I thought I was giving up my job at AIG. And we bought a 4-unit and house hacked and lived in one of the units with our 2 babies. And it was a big sacrifice, but we just were convinced that entrepreneurship was the way that I was going to be home with my babies.
Let me stop you right there for one moment, please. And so you guys heard, I interrupted in an inopportune time. So you got this office building for your husband's practice, or business. What sort of business was it?
He's a chiropractor.
Chiropractor, okay. And then you had 3 units above it that you rented out, landlord by default. And then you house hacked. You're already successful. You've got a good practice going on. You come out of AIG. That's not a low ticket job, and you decide to house hack. I'm so impressed by that, guys. when you can minimize your expenses early on. I mean, I remember when I had, I think, 300 doors, and I was living in a 1-bedroom apartment because I had free rent because I was able to market with this particular apartment complex with another business that I owned. Same. So, I just want to flag that for you guys. Don't be afraid to tighten the belt now to get what you want later. So please continue. So you house hacked a fourplex. Unbelievable. With 2 kids.
Absolutely. And when I moved here in 2003, I was the first and only work from home employee of AIG Corporation that had thousands of employees. So it was a temporary situation. They said, we'll give you 3 months to prove you can do it. So I knew I might be losing the 6-figure job and starting a new business. And most businesses fail the first couple years. So we made that big sacrifice in lifestyle, knowing that it would help us get ahead. So fast forward another year, we started a business at the worst possible time, at the height of the economy in 2007, Rod, because at the time I didn't understand market cycles. I didn't know we were heading in for the Great Recession.
Very few people did. Countries didn't. So, I sure as hell didn't. But I the only thing I can hang my hat on is that countries went bankrupt, okay? And big businesses did. So that's my story on that, right?
Yeah. So and not unlike anyone else, I was sitting there working for AIG. I had worked from home for a year. Husband's business did well the first year, and we had a massive stock market crash. Real estate crash. I worked for the company that was in the news every day with huge billion-dollar bailouts. And I was told, you're going to lose your job, most likely. So I thought, oh my gosh, what am I going to do? We had just started out. I was losing a 6-figure job. My 401k, Rod, was slashed. I lost more than 3/4 of my 401k during that. And as I was kind of in panic mode, thinking, how do I deal with this crisis that I don't have control of? What can I do that I can mitigate and that I can figure out? And I knew that I had enough left in my 401k. I moved it over, and I thought the one thing that's going well is my 4-unit apartment buildings. The tenants are paying, and there's a bunch of them for sale. So I borrowed from my 401k and I bought another 4-unit right as I was getting ready to lose my job, because I thought I'll have at least $1,500 extra a month that I can live on, buy diapers, buy food for my babies. Right. And I bought another 4-unit building. And that was the smartest thing I did, because it put me on that trajectory of realizing healthcare very quickly thereafter started to go under. My husband's reimbursements were cut 40% by Medicare, Medicaid insurance. His business was failing. My company was on the rocks. And the only thing good was my real estate. So I knew at that moment, I need to buy more real estate, create more passive income where I never have to depend on entrepreneurship or my husband's, business or my own company. And that the thought that my company was safe was really a myth. No company was safe. And so that's what really got me at that moment in early 2009 to say, I'm going to do everything I can to buy as much real estate I can to create as much passive income as I can.
Yeah. So, guys, this is a doo-doo moment. Yeah. Because I don't know where you think we are in the cycle, but I think we're headed for some pain. And yes. So even if I'm wrong, I think there still will be some contraction and opportunity. And, we had a well-known economist speak to the group. And he thinks it's coming right away. I just listened to Peter Schiff, another economist, on Joe Rogan, talk about the crash that's coming, and and forgetting COVID and everything else. It's just that we're in that place in the cycle, and so.
And we have to learn from the last time, right. And that was the thing. In the last 10 years, I spent my 10 years learning and saying, I knew a lot about investments and I thought I was really smart and I was, being cautious and conservative, but there was still all these unknowns. And I realized I have to become a student of macroeconomics, of microeconomics, of real estate cycles, of local markets. And I just started studying. And I thought we were at the top at the end of 2008. And I started slowly selling, even though I was buying, because I think you can make money in every market if you do it carefully. But I thought we were heading for a recession earlier. And so I've sold quite a bit to position myself to buy quite a bit when the market changes, but we've really got to become a student of the market. So we're not hurt as badly this time as we were last time.
Yeah. I mean, impressive that you saw it, because boy, I had my rose-colored glasses on, as did most of the world. But yeah, I will tell you, and you are very smart, by the way. Let me give you a public shout out on that regard. You're one of the smartest women for sure that I'm associated with. And And one of the things that she said, guys, is that she determined to buy real estate as a hedge. And I will tell you that I cited some examples in a presentation we did for the mastermind in that multifamily after that crash recovered and exceeded pre-crash rents within 3 years. Okay, and that was like the huge crash. And so multifamily and multifamily across the country, I think only pulled back about 11% as far as collected rents, which in most cases, unless you're stupid and aggressive in your analysis and projections on a property is a pretty conservative amount. So that's why we love this business. So fast forward to today, I talked about some of your stats, and I know you've bought a lot of this stuff on your own. And I would I be correct in saying in the recent past, you've started doing syndications and venturing out in more joint venture syndication type environment? Is that an accurate statement?
It is. And one of the things I love about multifamily, Rod, and even, interacting with a lot of your investors and in your mastermind and your boardroom, is there's so many ways to get in it and so many ways to get started. And depending on your time, your skills, and your money availability, there's a different size of asset that might work for you and even your location. So for me, I started out, I was running my husband's business, working full time. I had 4 kids. And I just was like, every time I can get a chunk of cash or figure out how to take down a deal creatively, I'm buying locally another 4-unit building because that's what was available to me. And there weren't a lot of investors looking for them. They were all going after the really big deals or the duplexes and the triplexes. So I had this kind of niche where I was like, there's opportunity. I can buy them cheap. It's really stable in a growing area. And that's what I'm going to buy. So I really created the financial freedom and replaced my 6-figure income on nothing but essentially 4-unit apartment buildings in a, rural Pennsylvania. And so I retired in May of 2019. So it's just been about a year and a half, truly financially free. But I was planning very methodically. I had a 5-year plan to, get to retirement. And about 6 months before I pulled the trigger, I thought now is the time that I can start living on this income, that I'm going to scale up and buy some bigger properties, and then I'm going to do it with partners. So I needed enough small properties I could bank on for 10 to 20 years of income that I wasn't really focused on joint ventures or value add deals that were going to turn every 3 to 5 years. So that's just the way I did it. But 6 months before I retired, I knew I've always wanted to buy bigger. Once I realized the power of the passive income, I knew I wanted to do it at scale. And I started looking for properties I could take down 70 to 100 unit buildings and as a joint venture. So I bought 3 deals as joint ventures with 3 partnerships that totaled 200 units. And I purchased 2 of those deals just before I pulled the trigger at AIG. And then from there, I started syndicating in the last year. And I've now syndicated 3 apartment buildings, and we're closing on our 4th 494 units Monday.
What markets are you in?
I'm in Atlanta, very close to you.
Yeah.
And I'm in Houston, Texas, and Central Pennsylvania. And I'm eyeing the Carolinas, but I haven't bought anything there yet.
Oh, we love the Carolinas. We're not invested there yet, but we love it. And we actually have an asset in Atlanta already. Just northeast of Atlanta in Oakwood. Actually flying to Dallas Sunday for a couple of new assets near one we have. And
I love those markets. Atlanta, the thing I love about Atlanta and even part of Houston is, even through COVID, Atlanta was one of only 3 cities that rents during COVID were increasing above what they were pre-COVID. So there's so much market growth. It's a conservative state, less lockdowns, lower taxes. Those are the kind of assets I try to go after, locations that, have strong fundamentals where I'm not going to get rent caps and tenant friendly, judges that won't let me evict people. So
let's not go down that political side road because I honestly can't wait till the election's over.
Oh, me too.
It is so frustratingly. It's so frustrating to me what I'm seeing.
And I just mean from an investment standpoint.
No, I got you. But I went there. Yeah, it's just watching the news again this morning, and it's so easy to get sucked into it.
Yes.
And I will tell you, I saw this fascinating movie. I don't know if you've seen the movie Social Dilemma.
Yes, it
Is
was
that
amazing.
crazy?
It was crazy.
I know, and it speaks to, and it really identifies the polarization that's happening in this country and the impact of social media. Guys, if you have not watched The Social Dilemma, write it down right now, and especially if you have kids, and go watch it, because it is sobering. It is honestly a little scary, but it is critical that you understand what's happening with social media right now, and because it's dead on. Would you agree? It's absolutely accurate of what's happening.
Absolutely. There's so much that we don't understand is being planted in our minds, and different people seeing different things to make them think that something's different is true than what you think is true. And it really, can cause our country to become, completely divided, more so than it already has been. So it's really important that we wake up to what's going on.
Right. Yeah. So back to this fun business that we're in, this exciting, frankly, recession, contraction resistant business that we're in, maybe even crash resistant, honestly, because just past crashes and how well and resilient multifamily's been. What's your favorite part of the business, Anna?
I really love most of it, other than hands-on do-it-yourself property management. It's about the only part that I don't like. I self-managed everything for until I retired. I self-managed 70 units with my husband, and that was a pain. So when I got to where I could shift from being property manager and asset manager to just doing asset management, loved that. I've been involved in hedge fund development and PPMs and private placements for years, so I enjoy underwriting and asset management, the banking, a lot of it. But mostly I love being able to see a business plan and see it come to fruition, and see us create, value, both for investors and in our communities. Really making a difference in the communities we live in is really important and exciting to me.
So you made it. I want to circle back to something you said. I just want to make sure I didn't mishear it. Do you not do value add deals?
Oh, no, I wouldn't say I don't do value add deals, but let me say this, Rod. Because I became a student of market cycles, I truly believe that value add deals, especially if you need bridge debt, because the best deals are usually those that have the most upside because they're a problem. So you're not going to get fixed agency debt. So you're getting bridge debt. You're hoping that you can turn the apartment around in a year or two. You can sell it top dollar because you think the market's going to go up, rents are going to go up, and you're going to refi and get out. When you're coming out of recession into recovery and you're in the growth phase, from growth to hyper supply, value add deals all day long. But as soon as you see pain and you think a recession is coming, and I watched all kinds of indicators to think it was coming sooner, even despite COVID, at that point, I think it's dangerous to have a value add deal that's a heavy value add where you're in bridge debt, because if you're going to have an economy that contracts, rents could come down, values could come down. And so even if I go in and put in sexy appliances, if tenants are worried about whether they're about to be laid off and can barely pay their bills, and now you have something like COVID, they don't care if it's granite countertops, stainless steel, hardwood flooring. They just want a nice, safe, clean place to live in a nice market. So right now, because I believe we're recession, and I think we're going to be into recession and recovery for several years, I don't want to enter into any heavy value add deals with bridge debt where I'm hoping things are better in 2 or 3 years, and maybe they're not, or maybe rates are higher. So I'm looking for buy and hold deals right now that I'm going to hold, 7, 10 years plus, with multiple exit strategies. I still want a value add component. I mean, I don't want to buy anything that's turnkey and just sit on it and have very low returns. But if I can find something where there's $150, $200 potential rent bumps without a whole lot of heavy lifting, and I can actually buy a stabilized property like that with agency debt, then I'll do those deals all day long.
So let me describe what you just said for some of the brand new people that don't fully understand. Guys, to get agency debt, the property has to be what they classify as stabilized, meaning it needs to be 90% occupied for 90 days. And a lot of heavy value add And that's why I asked the question. I'm really glad you clarified, because we're doing value add, but we're not doing bridge debt, for God's sakes, right now. No way.
Right.
And by the way, bridge debt is for you in the single family space is like the hard equity lending of the single family space. That's bridge loans. And they're great. They serve a purpose. But let me give you the other thing that we're not doing is we're not doing short-term loans right now, like 3-year terms, or even for us, even 5-year terms. Because let me tell you the definition of a bad day, like Anna just described. Let's say your rents go down, or let's say the cap rates change and you can't get the value you want, but you've got a beautiful cash flowing asset and you need to pay that loan off, and you can't get the value you need to be able to refinance. That's the definition of a bad freaking day. And I'm going to tell you, that's going to be happening to some people, unfortunately, that have this onerous bridge debt when this market shifts. So I'm glad I asked for clarification. That makes complete sense. And we're doing the same thing. I mean, these assets, we want to see a couple $100 a month in rent, a quick increase in rents based on that submarket and the competitors, but definitely no heavy value lifts right now.
Sure.
Yeah. Okay.
Yeah. And you know what? We just did one in Houston, and we're about to do another, big one in Atlanta submarket. And basically, Rod, we're just being really conservative on our underwriting. So we're trying to get, a discount now. We're assuming no rent increases for a year, no major CapEx for a year, even though we're still going to push. We're going to see what the market will bear and try to do that much more quickly. But we're just underwriting it to say, instead of saying, hey, this is a 3 to 5 year deal, let's assume it's a 5 to 7 year deal. Let's lock up that longer time debt. And then let's still try to be aggressive as the market will let us, be. Sure.
Bumping the rents. You bet. Yeah. Bumping the rents. We've always been conservative. Like, we closed on an asset in Cincy, and we can break even at 65% economically occupied, which is super conservative. And we've got over $1 million in the bank in a just in case fund, operating reserve. So heavy operating reserves, and much more conservative on our break even, and that's just prudent right now. And there've been a lot of skinny deals done over the last few years, and I hate to say it, that's why I talk about I put my rose-colored glasses on. I'm not going to look at it from a fear place. I'm going to look at it from an opportunity place.
Absolutely.
Yeah.
Yeah, and I think it's important not to overpay, Rod, because what a lot of people that I see out there, they're thinking, I've got to pay top dollar or I just can't get a deal done. And when we talk about the asset size, the reason I still buy small properties, medium-sized properties, large-sized properties is in some markets, like very large assets, you've got institutional buyers that are going after those, and they just want a preservation of safety play. So like you mentioned, multifamily was very resilient during the last recession. So people are willing to pay top dollar, park their money there, and take low cash on cash returns just so that they have a safe place. So if we're trying to compete with the same deals, it may be tougher. But if I go after a 75 or 90 unit property, I have less sharks swimming for those assets that are just looking for a safe place to park their cash. And I can still get deals done in this market that are still conservative, still have some cash flow, as well as that preservation of principal.
Yeah, same. We just bought an 88 unit. Actually, we're closing on in 2 weeks. Same. So yeah, I couldn't agree more. Go for the low hanging fruit. And I may even go a little smaller than that if it's in my backyard here. I'd look at a 20 unit, a 30 unit. Robert's not too excited about it, but why not? Especially if they're distressed, and I've got a management infrastructure here locally. Don't use it a lot, but it's here, so why not? But I heard your alarm go off. Are you good on time, or you've got a hard stop here?
I'm so sorry. I don't know why it's not muted. I'm good. Let's keep going.
All right. We'll go just a little bit longer. So what would you tell, let's speak to women for a minute. What would you tell a woman that thinks she might be interested in this business and hasn't pulled the trigger yet? What would you say to that person that maybe has a job, thinks they really love real estate, wants more for their family? What advice would you give them?
Sure. I would say get started right away. And that it's not going to be easy. It's not that complicated truly of a business, but it's not easy. And so, as a woman, especially if you're juggling kids and maybe you're working a full-time job, it's very difficult to find time to do anything. But the reality is, if you really want to change the financial trajectory of your family and you really want to create that time freedom to be home with your kids, you've got to be willing to carve out the time and just make the time. So when you have a vision big enough and compelling enough, and for me, it was, I got to get home with my babies. Because of the crash, it took a lot longer than I thought it would. I ran out of money. No one would lend to me. I could have given up so many times, but I wanted it badly enough that I said every single day, I will carve out some time to take a step forward toward my goal of financial freedom and to do whatever it takes, to take up whatever time it takes to make it happen, and that it's all worth it. You've just got to get started. You've got to take daily action. Keep that vision at the front of your mind when things get hard. Remember why you're doing it. And then just keep with it and don't give up, because real estate truly is, and I've seen and worked in every kind of investment for the wealthiest of the wealthy in our country. There is nothing more powerful than real estate to create financial freedom, to create wealth, and to preserve wealth than anything else available to us in this country.
Yeah, preserve wealth is the word, because the tax benefits are off the hook. I mean, they're fantastic. And one thing you said about carving out time and continuing to move forward, happiness doesn't come from the goal. It comes from that continual progress and growth. And you may have delays, you may have setbacks, but as long as you're progressing, you're happy. And that's critical. And yes, you may have to grind for a few years and give up some time with your kids for a few years to live the rest of your life like most people can't live. And that's why we do this. So let's talk about a time you made a mistake in this business and what that might have been and the lesson in it, if you would. A real doozy, if you can remember a good one.
Sure. I would say, the biggest mistake that really wasn't a particular deal, but just a mistake that I made that slowed me down, Rod, is that, in 2009, when the market crashed and I had no more money, I lost almost all of it. I just used what I had for my 401k. I couldn't get banks to say yes. We had $700,000 in business startup debt for my husband. So we did not look good. And I basically just waited until I could find ways to scrape money together, borrow from people to find a deal. And I didn't want to partner with people because I had been jaded by a fraud coach. And I was like, I don't want anything to do with, coaching and seminars. And, I just got jaded. And because of that, I did it all alone. It was my husband and I. He did maintenance stuff, but I handled the trying to find it. And I felt all alone. I didn't have a network and I didn't have anyone to partner with. And when I finally said, I can't go any further, yes, I learned creative financing and I took down several deals creatively, which I'm thankful for. But it wasn't until I started partnering and saying, do you want to buy a deal together? You put the money in, I'll put my knowledge and the time in, that I really started to be able to scale and maximize my time. So that I could do what I was good at, use other people's money to take on those deals. And I wish I had come to that realization and not been afraid to partner much earlier than I did.
Yeah. Hey, guys, I'm so glad you said that, Kelly. And I'm sorry to hear about your mentorship experience. We actually, we interview our Warrior students all the time, and many of them had similar experiences, very expensive experiences, like $30,000, which is quite a bit more than we charge. Yes. And they lost, they pissed it away, and it's sad. Fraud. I may want to ask you about that after the recording turns off here. But wow. And guys, now let me ask you this: how do you feel about mentorship and coaching? What is your personal opinion? Are you still jaded, or how do you feel about it in general?
Oh, no, not at all. The key is to find somebody that really has the experience of what they claim. That they're really going to come alongside you and help you. And they're not making more money on coaching than they are doing deals. Yeah. Because if they're mostly just a coach and they haven't been in the business and doing the deals, they're motivated by just bringing in more students, not really helping. But reaching out to somebody like you that's done deals, that's been in real estate for years and years, and you're still actively doing deals, that's what you want in a coach and a mentorship. And I just didn't really have the knowledge to I checked this woman out, and she had all of her own social posts, like press releases, but they looked like they were from big businesses, and it was really her making up her credentials. It was put on by a big, real estate group. So I thought, well, surely they vetted her, and they didn't. But yes, mentorship will help you go further for sure, because you have somebody that has experience that's going to help you not to make the same mistakes that you would as a newbie by yourself.
Yeah, and you talk about environment. I mean, I will tell you, in my 20s, I did millions of dollars worth of deals, 50-50 with partners. So those of you listening, I don't know about you, but I would take 50% of something over 100% of nothing, like any day, yes. And it took you a minute to get that realization as well. And, we bought, I think, just over 1,500 doors with our students just in the last 18 months. So we partner a lot as well with our students, but we've created this incredible ecosystem. I mean, it's just truly awesome.
It is great.
Yeah, thank you. Thank you. Well, listen, I really appreciate you being on the show, Anna. You always are such a treat to be around, and that brain of yours is very, very impressive. Is there a question that you wish I would have asked that I didn't ask?
No, I think you're a great interview host, Rod.
Oh, thank you.
I hope that this brought value. I think the key is, we're heading in for some pain. Yeah. Become a student of the market. Just be conservative right now, but don't stop staying in the game just because there's fear. You've got to be able to say, these are challenges. How can I create solutions and create opportunity to continue to grow my wealth through these times?
Perfect ending. Thank you, Anna. It's great to see you, my friend. I'm sure we'll talk. We'll see you soon. I know we've got mastermind events coming up both next month, and we're going to do a post-election one, talk about the election results, and then we've got a big one in December. But it's great to see you. Thanks.
Good to see you too, Rod. Thank you.
Thanks.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step, and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 41411. That's mentorwithrod.com or text CRUSH to 41411.